A major turn in oil ahead, and investors should be looking to REITs and home builders. That's the view of our next guest, who sees a breakout looming in the price of lumber. Joining us from New York is J.C. Parets, president and founder of Eagle Bay Capital. He's also editor of the technical analysis blog allstarcharts.com. J.C., Happy New Year.
Happy New Year, Francis. How are you?
I'm great, thanks. Let's start with REITs and lumber, and I'm going to back into it. You don't see the U.S. Fed changing rates at all this year. I know you had a great call last year on the bond market, one of the few that did. You think bonds are going to continue to be a good spot this year, price-wise, and the Fed's not going to move. Why?
Yeah, well, I appreciate that. Yeah, last year, I mean, the bond trade was the big winner. You know, talk about, looking at things from a contrarian perspective. Economists continued to tell us to sell bonds, that rates were going higher, and, I'll take the other side of that all day. They're still telling us that rates are going higher to sell bonds, and, we're still going to take the other side. We want to look at forward-looking markets, Francis. The Fed Fund futures market has nailed this trade from the beginning. Fed Fund futures continue to suggest that rates are staying down. The highest probability right now, we're looking at the late October meeting, October 28th, for the first hike, and these dates keep getting pushed back. So that's really the tell, and that's the market we want to watch. It continues to suggest that rates are staying lower. So the obvious trade is to just buy bonds. Bonds, in my opinion, are a little stretched up here. We've already hit our upside target, so we kind of want to let them digest these gains. I think that the trade is really on the equity side, Francis. Last year, some of the best performing sectors were those with the highest dividends. Utilities, real estate investment trusts, things of that nature. These sectors more than doubled the performance of the S&P 500, and there's a very good reason for that. Fixed income investors that are looking for yield that can't get it in the bond market, they got to go to the stock market and get the dividends. So that's why those sectors, in my opinion, were the outperformers. So far, we're seeing the same thing. Real estate investment trusts on a relative basis continue to outperform S&Ps. I don't see that trend changing, and the market is very intelligent. The stock market is very smart, and the stock market is also telling us that rates are going to stay down. We're seeing that demand coming into the higher dividend-paying stocks. So that's the reason I think rates are staying lower.
Some people might get a little antsy. We've been just looking at the IYR, which is the iShare, the U.S. REIT iShare, and it's back to levels last seen, well, let's call it the fourth quarter of 2007. Some people might get a little antsy buying it on this new high list.
It just broke out. These are fresh highs. This is something new. And also look at it on a relative basis. If you look at an IYR SPY spread, that just broke out this week also. So, you want to talk about, new trends. I think this is something new, particularly on a relative basis, that outperformance out of the real estate investment trust. It's a trade we've had on all year. We continue to keep that on, and we have higher targets on the IYR SPY spread. I really like that. But now what we're starting to see, those are higher dividend paying stocks, but now we're seeing money flowing into the actual home construction companies, the home builders. These charts look great, Francis. We talk about, the ITB, which owns, Pulte Homes and Toll Brothers and Lennar and things like that, the home construction ETF by iShares as well. That's a big, solid, multi-year base. I think we get a breakout very soon.
And when you talk about breakout, I think you're referring to this relative strength breakouts. Is that the case when you're talking about a lot of these graphs?
Well, actually both.
Okay.
It's a great question. On a relative basis, on a relative basis, it just broke out this week. But on its own, we keep bumping up against that overhead supply in the ITB, call it 26.5, 27 for the last couple of years. And, you and I, we talk about this all the time, right? The more times that a level is tested, the higher the likelihood that it's going to break. And we bumped up against these overhead supply, 4 times arguably. So I think we get a monster breakout in the ITB, which is very concentrated in those home builders. But then look at something like XHB, which is the SPDR home builders ETF, which is much more diversified and owns, not just the home builders, but companies that, home furnishing companies and companies like Whirlpool, things like that, that have exposure to, purchasing of homes and things like that. So it's much more diversified. It also looks very good, both on an absolute and relative basis. So those are two sectors that I think in the first quarter can be the big winners.
So that's where you think you can make money right now. A lot of people, of course, up here, we watch oil, the energy space a lot. I know you don't want to act on this trade yet, but you're watching oil. You watch everything really closely. You told my producer that the elastic band was pretty stretched. When's kind of hard. What can we watch for on the charts for oil?
Yeah, I mean, listen, we do a lot of sentiment analysis, as you know, and they hate them. They hate them, Francis. We haven't seen this much pessimism in the oil market since the bottom in early 2009. So we know the market hates it. That's not a surprise, obviously. When we look at actual price, which is what's important, that $40 level really stands out. That was overhead supply in the early 90s, back in 2002, 2003, again, overhead supply. Then we broke out of that, retested that successfully at the 2009 bottom. I think that's probably where we're headed. We don't just want to blindly bottom fish. That's not what we do. That's very poor risk management strategy. So what we want to see is when it's making new lows, we want to see momentum diverge positively. This reminds me of conversations you and I used to have when natural gas was crashing, back in 2011. And if you recall, what we were looking for was one more low and then momentum diverge positively, put in higher lows on those new lows. It's basically the same thing, like Yogi Berra said. It's like deja vu all over again. If we can make those new lows down towards 40, momentum puts in a bullish divergence, I think we can get a big rally. And, sentiment and price is very much stretched from the mean. So that reversion is going to be it's going to be powerful. So we want to take advantage of that on the long side, when we do get that opportunity.
And you'll tell us when it happens, JC?
Sure. You and I, we communicate via email all the time, so just keep checking in. I'll keep you posted.
I'm just giving you a hard time. You've had some great calls. Always good to see you. Happy New Year.
Happy New Year to you, Francis.
JC Parets is president and founder of Eagle Bay Capital. He's also editor of the technical analysis blog, allstarcharts.com. You can follow him on Twitter. Has a wealth of information both on his website and the information he provides to us regularly.